Let's talk about mandatory and optional taxes. What do I mean by that? Well, I hope you understand that all of the money that you put away in your IRA, which has been tax deferred, and you got the tax deduction on the contribution when you put it in, will eventually be 100% taxable. I always think that's a no-brainer, right? Everybody knows that until they forget it when it's time to take the money out. But here's what you may not be aware of, and something that I think could really make a difference. When you pull that money out of the IRS, who frankly has been a joint partner on that account with you, even though your name is the only one on the statement, the IRS is going to get paid first. And the tax that comes out is mandatory. But here's the difference between mandatory and optional. I'm going to give you a quick example. If you had a $500,000 account and took the money out all in 1 year, whether you took it to spend it or whether you did a Roth conversion and put it into a tax-free account, you'd have to declare $500,000 in 1 day, and the tax would probably be very, very high because it would put you in the highest tax bracket. We don't typically recommend that. We usually do a tax strategy where we take that money and maybe do a conversion over 5 years. Now we're only taking $100,000 a year for 5 years, or whatever would fill up that bucket. But let's assume that we took $100,000 a year for 5 years, and then each of those years you were in the 25% bracket. That means that you would have to stroke a check for $25,000 5 years in a row. Painful, I know. But wait, the story gets better. You now have $500,000 in a Roth IRA, and the IRS has $125,000, hopefully from a different bucket, because you never want to net that out. So they've got their $125,000, you've got your $500,000, which now can continue to grow, and it's all great. That is mandatory tax. There's no way you're going to get that money out of that IRA bucket without giving the IRS their share. Okay. What did I mean by optional? Well, do you know that most people, when they turn 59 and a half and are finally eligible to take the money out of their retirement accounts, oftentimes choose not to? And when I ask, why would you not want to take that money out? They usually say it's taxable. Again, this is where you forget, right? It is taxable. And they don't want to take the money out because they don't want to pay the tax on it. I got news flash for you. You can run, but you can't hide. The IRS is patient and they will wait. Unfortunately, used to be at 70 and a half, then it went to 72, now it's 73. The required minimum distribution must be paid based on your December 31st of the previous year balance. So let's say you were 60 and you said, I don't need the money and it's taxable and I don't want to take it. Okay, great. So from 60 to 72, 73, we're going to say that account doubled. So now that $500,000, which you haven't paid any tax on yet, is now worth over $1 million. You figure out annually what you have to take as the required minimum distribution, and you pay your taxes. And maybe it's a smaller check than $25,000, maybe it's a bigger as it goes on, whatever it is, there's going to be a lot of them. And in my story, unfortunately, you're going to die at 90 years old. So from 72 to 90 years old, the amount of distributions that you took and the balance in the account that is still taxable at your death is going to be 100% taxable. So now the amount that's in your account is still taxable at death. Do you know that based on our tax burden analysis, which we're happy to run for anyone who would like to see it, doing that structure, taking it out only as you have to over your lifetime, will bring your total tax burden to over $450,000. And that's assuming that taxes don't go up in the future. And I don't know about you, but I'm pretty sure that is not going to be the case. I don't have a crystal ball. I can't predict the future. But I can tell you that the likelihood that taxes will be lower than where they are today is probably sitting on the shelf next to slim and none. So if you have the option, mandatory tax, to pay $125,000, or do it the way the IRS is encouraging you to do it, which is to take it out over your lifetime, only the minimum that you need to take, and pay over $450,000. That's almost the whole size of the original account. Which would you rather do? Please take your time in answering this next question. Would you rather give the IRS $125,000 or $450,000? You see, that $450,000 minus the $125,000 or $325,000 was actually optional. Why do I say it's optional? Because you chose that option to take the money out over your lifetime instead of ripping the Band-Aid off, paying the IRS, and then having the $500,000 to grow or do whatever you wanted it to do for you, for your family, and to be able to leave it completely tax-free to your family as well. $125,000, $450,000, that difference is optional.